Welcome to Trillium's Plain Talk. I'm Steve Laska, managing partner here at Trillium Wealth. And as usual, I'm here with my partner and chief investment officer, Matt Gomoll. Matt, I think we want to talk a little bit about, we've had that AI euphoria and the chip trades, and all of a sudden in July, it looked like, I just saw the Odyssey and there's like a whirlpool just sucking everything down. Talk a little bit about what we saw in July and what we have to look forward to maybe.
Yeah, it really was a rotation, right? And rotation means this is kind of trying to understand why part of the market is going down a lot, collapsing in the chip sector, but the market wasn't, was still within a couple percent of all-time highs. And that can be confusing. That can be like, why is there all this volatility? I'm seeing stuff on the news of these stocks being down and the AI trade being over, yet the market held up. And it's due to the classic rotation effect where you move from, investors move from paying up for certain stocks. Chips, in particular, were really hard hit. So they had been paying up a premium to own chip stocks. And then they say, hey, I think this has gotten a little out over its skis, even though the earnings are insane. The revenue that Micron and other companies are producing is insane. They look and say, I don't think this is sustainable. I don't think this trend is a multi-year trend, forecasting out 5 years. And therefore, I'm going to take profits and move somewhere else. And that kind of precipitated the collapse in chip stocks.
Do we see that as long-term though? Because, I've talked about this before. AI is going to move. There's a lot to AI. It's not small. It's a huge thing. And internally, inside of AI, it's going to move at different speeds. Like, do we have enough data storage? These data centers. Do we have enough power? Do we have enough water? Do we have all these things? But what we do know about chips is the more memory, the better AI works. Like that's like a law of physics type of thing, right? It's just the law. Like if you have more memory, it works better. So are the prognosticators doing some profit taking now and saying we're waiting for the rest of AI to catch up? Or are they saying like there's other, like usually when if chips start to fall or anything starts to fall, it's because there's new competition in there that's going to do it better, faster, cheaper, so to speak. What are we seeing out there? Is it a wait for the rest of the things to catch up, or are there just new competitors in there?
Yeah, there's not. There was a Chinese company that got listed in China and was all of a sudden one of the biggest stocks in their market. This is one of the areas that there shouldn't be these excess profits accruing, right? In a stable market, there shouldn't be Samsung and Micron and SK Hynix capturing these just massive profits. But the demand is so high and there is no other competition yet, right? So I would say like it's twofold. One, there should be some new entrants into this space, even though it might take a while. You just would say, I don't think it's sustainable for these just massive year over year growth numbers for these companies to persist. They should get competed away, even though it might take time. And then the other part is because these chips cost so much money, there's a huge incentive for the hyperscalers and the AI models to make themselves more efficient, to use less of it, right? And so it's kind of those two things saying, hey, we've pulled forward a lot of profits. We've been able to price these chips at outrageous amounts because the hyperscalers are just paying for them to put them into the data centers. We don't think that's going to continue at this trend, right? These companies are going to keep doing great, but it's that change back to cyclical. They're going to move, have ebbs and flows like chips have always done. And that's kind of what I think we're seeing, is just saying, this is these record profits are amazing. We don't think it's like 5 years sustainable. And they certainly, the valuations on these companies really did get stretched. Not to say they're not going to be good companies going forward, not to say they're bad investments right today, just that in all at once, the market, and investors kind of said, hey, this sector is a little hot and let's put our money to work somewhere that we can get more value.
So, do you think any of it comes down to like we've seen this, in our own experience, and I can just read about it, like how long it takes to get a data center up and running. Like, forget the actual
Mm-hmm.
build. First, you come in and somebody says, "We think this piece of land works." And as again, we have some of our own personal experience with, not every piece of land even works. Like the power grid isn't close enough to deliver the power. There's not fresh water that, again, these things eat. Um, so you have the first thing where you have to identify a piece of land, get somebody to agree to sell it to you. Then comes zoning. And this is not like a 2-week process. This is, we've seen and heard stories where like somebody wants to buy a piece of land and they want to close on X date, and that date ends up pushing out 2 or 3 years, and there's always danger of it not even happening. Because as soon as you get approval, zoning, then come the lawsuits, right? And the lawsuits from local, local people going, don't want that here. Here's the reason why. And then that stretches out.
Mm-hmm.
Is part of this an effect of just like again, these data centers, like there's a lot of people that want to build them, but there's not a lot of places. Like Maine literally outlawed them now. Like the
Yep.
state of Maine said, no more in our state. Can that have an effect on chips?
Yeah, it could, in that there's plenty of demand to buy them, but you can't actually put them places because you didn't build the data center, right? So what we're seeing with this, the AI ecosystem is many, many, many layers, of which like the frontier model, the Anthropic, the OpenAI, kind of sits high up, right? Like they're the ones designing how the AI works, but then under the hood is the data centers and the chips that are in the data centers and the energy that powers the data centers and the land and all these things. And whenever there's a bottleneck in any one of those spots, all of a sudden you see value accrue there because these things are in demand, and a bottleneck creates scarcity. So to your point, because it's becoming harder and harder to get a data center approved, the land is very valuable, right? If you can get a piece of land zoned and approved, that's going to be a really valuable commodity compared to another use for that land. And then you get the power generation. Now, like the power generation, utilities are regulated, and so they're not, having a ton of profits at the back of consumers and data center companies. But the companies that make the power generation equipment, GE Vernova, hugely profitable. Like they are, somebody has to buy the turbine engine or the other stuff that goes into a power plant or the electrical grid. And there's scarcity there, and you're seeing a lot of value created there by those companies. And so at each one of these places, there's just so much investment, so much, money flowing into get these things up and running, that it's being captured in all these unique little areas. Chips was, the most recent one where people said, hey, there's not enough chips, and these AI models are becoming more and more memory hungry, right? And it gets back to early AI models. They you just have one chat and they don't really remember anything. They would forget everything you just talked about 5 seconds later, and you'd start over. And now you're creating these context windows of a lot of information pulled in from past conversations, and they're getting smarter and better. But that's memory helping to do that, right? And so that's kind of the driving force this year of why chips were just a really hot pick.
I think it validates, on one of the recent podcasts, I talked about IPOs and, how they're coming out. We talked about IPOs and how, they're coming out and you already know who they are, right? And I said, if you already know who they are and there's all that heat, your quick rise or that huge return that you think you can get, that's probably already happened. The chip trade to me validates like that for all of our clients. Like I was talking about Micron right before we came on, and you got the guys at Goldman still saying, well, we target at 2000. It's at 900 right now. Its 1 year return is 720 something %. But God forbid you bought it on June 20th. right? I mean, that's and that's
Mm-hmm.
kind of what we're trying to tell clients all the time. As far as wealth preservation doesn't mean you're conservative. It means you're preserving your wealth and growing it within the context of your kind of future and things that you and I have talked about on wealth transfer, all those things. But I I guess the question everybody's going to ask now is, and you seem to be alluding to, like, maybe this is like a resetting of this, of these stocks, where it's like, okay, it's going to settle in for a while. Don't expect that it was down 30% in July and it's going to be up 60% next month, because there's clearly something here that the market is telling us that this isn't your kind of normal, profit taking, so to speak.
Mm-hmm.
Like, this is a real thing that's endemic to what analysts are seeing in the industry. Like, this is a reset, not a profit taking. Is that what you're subscribing to right now?
Yeah, I think it's showing that the valuation got really stretched, and investors kind of agreed, hey, this is not going to be a sustainable plan. And so it's reasonable, right? So when you're up 1,000% to fall 30%, uh, while from the high watermark feels really painful. And if you invested at the high watermark, not good.
Right.
But in the context of a 1-year return, very reasonable for these things to get a little bit back down to earth. And it's okay for stocks to correct over time, right? To fall, to go sideways, and allow the market to catch up and allow their earnings to continue to grow so that they can then move higher. I was just pulling it up. NVIDIA, we all think of NVIDIA as just a high flying, one of the best. It's
The platinum standard.
It's
Yeah.
the second biggest company in the world today, I think, behind Apple, as those two go back and forth. It's underperformed the market over the last 1 year. You wouldn't have thought that. It's up, 1-year return about 18% compared to the S&P total return about just under 24. So for NVIDIA, that's relatively going sideways, right?
Yeah.
And so it's those kind of things that it's okay for a stock that did that well to take a breather, to underperform a little while. And some of the Mag 7 have been underperforming the S&P, and that's okay, because it shows that there's health in other places, right? For in 2025, it really felt like the Mag 7 were just driving everything, and the rest of the other 500 stocks were just kind of along for the ride and getting dragged. And now it feels like there's some parts of the market, financials, healthcare, that some traditional value sectors that are doing good. And we want that. That's healthy for a bull market to say, hey, some other sectors can do well for a while. We don't have to have these face melting returns in chip and AI related stocks. It's good for other parts of the market to have some returns and lead for a little bit.
Well, other tech things have done well. Like, I thought I saw something where, like, Microsoft the last month or so is like the best performance since 1999. Apple suddenly reemerged as the most valuable stock in the world, right?
Mm-hmm.
I mean,
yeah.
So it's even in the tech sector where other things have been like, we're not just kind of a one trick pony. We have some other things going on here. And like, for a company the size of Microsoft to go up 25% in the last month or so is enormous, right? Because, I mean, that's something that's followed pretty closely. Like, that kind of stock, and Apple, these are not stocks anymore on these days that are like, you're speculating on what they can do. They're behemoths. So if they're moving like that, they're moving on real data, like real financials, real information.
Yeah. And what's so interesting about especially these big ones, they have so many business lines. Microsoft, Apple, Amazon, Google.
Amazon.
They have so many different business lines that they're not, in itself, it's a diversified business. I won't go so far as to say it's diversified in the way that Berkshire Hathaway is almost a pseudo index.
It is, yeah.
There's a lot going on under the hood of a lot of different tech plays at both in Amazon and Google. And Apple has done fantastic because it doesn't have all the CapEx, capital expenditures that the other hyperscalers do. It's just said, hey, we're going to sit back, let you guys play. We're going to make great hardware, and we believe AI is going to be on device, and we're great for privacy. We're great for all these things. And the App Store charges basically a toll, right? It's a great business model of we create a good device that everybody's in the world is going to have at their fingertips. And if you want to be on it, you're just going to pay us a cut of revenue that you receive.
Yeah, it's pretty brilliant actually, because
it's great.
like I said, they're doing really, really well. And it used to be that their stock was rising on, the new iPhone coming out. Like nobody's even following that anymore. Like I had to look because I was like, my phone's moving a little slow. Should I get a new one or should I wait? It's like a new iPhone coming out in September, and everybody's like, really? Like you have to literally Google to find out that that's happening. Whereas 5, 6, 7 years ago, we'd be talking about the next phone for the last 90 days, and people would be standing in line for it. So these companies have done wonderful work, and they've got wonderful leadership in them. Anything on this that other than Matt, like it's like, hey, this is just kind of the nature of the beast, and it's why you diversify, and it's why you don't get, it's why you buy all these companies are great companies, by the way. Like you said, I mean, Nvidia's I don't want to jinx it, but it ain't going anywhere anytime soon. I mean, it's there. It's powerful. It's got a great future. It's just not, a sit back and respect, and expect to get 1,000% return in the next 2 years.
Yeah, it is. I think it's healthy when the market corrects, especially in high flying sectors, and allows things to catch up, and allows, in investing, you don't want the narrative to get too far out in front. I mean, if we take this back to the .com era, those companies were absolutely right about the transformative effect of the internet, without a doubt, right? Fast forward 15 years from 1999, and the internet had transformed society, commerce, all these things. It's just they were way too far ahead on the valuation based on the narrative, right? The earnings were not there for those companies at that time. So here, it's good to have pauses in the bull market for the earnings to start to catch up, right? We haven't yet seen all the productivity gains and all the profit gains that use of AI will create for the entire economy. So it's good to kind of reset things and not get too far out of our skis with any one of these sectors, and just allow the whole narrative to catch up. So I think that's a healthy thing. I do think over the next few years, if AI is going to be proven to be useful and economically valuable, the benefit will diffuse across companies, not just be concentrated in who makes the model, who runs the data center, who hosts it, and who provides power to it. It's going to actually come to the companies who are saying, hey, I just use it for my payroll or my accounting or my sales process or whatever it is that you're using it for that makes you better and more profitable. And that'll be a good thing as that starts to catch up.
Yeah, that's where I'm at on this. I actually think that this is a very good sign when we talk about of alleviating people's fears of, AI is taking over the world the next year or two. I think this reset is basically showing that other things have to catch up in order for it to be functional, in order for it to be usable. I think a lot of people have figured out that it's not free. It's far from free, right? To actually use it. The more you get out there and use it and you get behind, a lot of folks will be out there using a free version of AI and think that that's kind of it. And they're just using it as a search engine, right? Or doing doing an email. As you start to use it, like I think I'm starting to use it and others are right now, like it's not free. It costs. And that will temper people as well. So I'm very excited by it. And I think it's a great thing that, like you said, it's getting diversified. The, those 7 stocks, it didn't just seem like it. I mean, they were driving the market, right? And there's always, kind of a reset. And I think that's good. It's good for the markets and it's real healthy. There's so much going on in the world right now that it's always shocking to look at the market and say it's still going up, right? It's like it's still going up. There's wars going on, there's inflation going on, and it's still just kind of cooking along. And it's cooking along now without it just being these kind of like, AI stocks, chip stocks. Everything's kind of propped up there pretty good. So
Yeah, well, I think
good
that's
signs for the future.
And what you said there is a good reason that you never want to make knee-jerk reactions and get out because of one thing, right? Inflation could have been enough reason to say, I don't trust this. Like, I'm scared of inflation and therefore I'm scared of rates and I should be out of the market. Or this war went on, oil prices I'm worried about, I should be out of the market. Or look at this chip collapse, I should be out of the market. Like, there's always going to be some bad news to say, I don't trust this, I should get out. And you have to overcome that. And the way you do it is with managing your risk, have a balanced portfolio, and weather through those, because there's going to be tailwinds pushing things higher that you don't want to miss out on.
Yeah, I think the net answer is, and again, I'll be pretty emphatic on this one, is it's get professional advice and use it. I mean, at the end of the day, we've talked about it before. Vanguard talks about a 3.5% annualized difference between using professional advice and not. And that's one of the great direct companies of all time, right? It shouldn't be confused. Like, I think people look at something like that and go, well, I didn't get outperformed by 3.5% this year or next year or that year. No, it's the 30 or 40% mistake you make. Mm-hmm. And like, get advice, take it, and like, here's an advertisement for good advisors. Like, go to advisors that are willing to push back at you on your ideas. That's the conversation I had with a teammate's father yesterday. His wife had sold a house 20 years ago, and she has $150,000 from the proceeds of that. She put $100 20 years ago in a CD. I'm like, if she were in an S&P fund, it would be worth $800,000. There was silence on the other end of the phone. And I did say to him, I'm like, I'm not saying your advisor isn't competent. They are. I'm saying they're not extraordinary. They're not extraordinary because their job is to not let you make that decision. So this is a good example of where advice matters, is getting out there and saying, because there's a lot of moving parts. And like you said, I think everybody thinks NVIDIA is still cooking along, and I wouldn't sell it. But like you said, it's outperformed the broad market over the last 12 months. If you ask the average person on the street who knows who NVIDIA is, what do you think NVIDIA has done in the last year versus the U.S. market? I would be shocked if they didn't say double, triple, quadruple, right? So it's a reason to get out there and listen, and things are always moving. So, all right. On that note, we'll close today and look forward to our next ones. I don't know if we'll get it by the next time, Matt, but I do want to start to get some guests on here to talk about some different topics. And I'm looking at somebody to come on and talk about things like clean energy. I'm looking at somebody to come on and talk about the small business environment in the country today, where you and I reside. We run a small business today, and I think it's a wonderful place to be, and want to encourage others to do that as well. So with that, Matt, as usual, thanks, and look forward to next time.
All right. Take care.